the expansion decisions of any firm, and then the second classification is the optimum capital structure. According to the investments, this is all about determining the best mix of debt and equity. But first of all, let us concentrate on the financial decisions of any firm, and in this case, we are looking at the optimum capital as one of the subdivision of the financial decisions. So we have the various theories that explain the optimum capital structure in deep. So we have the first one, which is the net income approach. The second one is the net operating approach. And we have the third one, which is the Modigliani and Miller's approach. Modigliani and Miller's approach is subdivided into three. We have the Modigliani 1, Modigliani 2, and Modigliani 3. Modigliani 1 is this one is based without taxes. This one is with taxes, and this one is with taxes, that is both the corporate and the personal taxes. And then you have the Modigliani 4, which is about with financial distress. So let's look on the optimum capital structure under the net income approach. And in this case, we always consider where we have the minimum cost of capital, and then we have to maximize the share capital. So under the net income approach, we see that a firm's value, like in terms of the value of a firm, will always be equal to the value of the debt, that is the debt proportion in the firm, and the share capital in the firm. The debt represented as a B, to say it's a bond. A debt is always on like it's like a perpetuity interest, like just this is like a loan, like you pay in terms of interest slowly by slow, day in day out, just after within a specific period of time. So this interest we pay either annually or semi-annually or quarter-annually. So in either way, we also know that perpetuity is equals to annuity over the interest rate. That is the rate of the bond. So in this case, because we are dealing with a bond, which is a debt, the annuity will be now the interest that we pay on daily basis, and the rate will be the rate of the bond, which is represented by the cost of the bond, giving us bond is equal to the interest over the cost of the debt. Let's take a look on the S, which simplifies the share capital. So the share capital can be different. We have with no growth rate, constant, just a constant, like there is zero growth rate. It is also done the same way as the bond, where we say because dividend we pay throughout and there is no growth, so we say it's just the same way, but in this case it will be dividend over the cost of the share. That is the case with zero growth rate. Then when we have a constant growth rate, that's why we say an S is equals to D into 1 plus the growth rate over the KS minus the growth rate. G is the growth rate, but we also know that G is equals to B times the rate, which is the rate on investments, but that's a topic of another day. So for these financial decisions on the optimum capital structure and the net income approach, those are the formulas that we apply, and then this is where you say the final formula for net income approach will be equal to, that is B plus S, and that is the value of the firm, is equals to B. Our B here was interest over the KD, then plus our share, which was what? Which was the earnings before interest and tax minus interest all over what? the KS. I know you are questioning where I got this one, but we always know that B is the retention. This is the retention. Is the retention. B is the retention rate. But in this case, we are considering 100% dividend payout in this case. So if there is 100 dividends payout, that means that nothing was retained as retained earnings. So that means that the earnings before interest and tax minus interest itself, the interest, this is the full amount, the full profits ready for to be shared.